Good evening, everybody. Welcome to the class on Portfolio Management CFA Level 1 by Finstructor Mumbai. My name is Aditya Aluwalia. Call me on the number or email me for any doubts after the lecture. Enrolled students should have received the question bank of over 3500 questions. Practice is the key to success on the exam. Please practice as many questions as you can. Visit us on the website for more information about our products. Email us or call us for any further queries. Now, in the topic on portfolio management, we are asked to evaluate the circumstances of individual and institutional investors, understand their requirements, and advise a portfolio allocation. So essentially, you are given a bunch of money. You now need to decide, depending on the capital market expectations, that is what returns you expect from the markets, and the individual circumstances of your clients as to how you should invest their money in different asset classes and in different individual securities. So what are the steps in portfolio management? First and foremost, write a policy statement. A policy statement is a document that clearly identifies the return objectives of the client as to what are his desires, what are his goals, and the risk profile or the risk tolerance of the client. So to reach these goals, how much risk can the client undertake? Once you have documented the policy statement, you need to develop an investment strategy. The investment strategy will come from evaluating the capital market expectations, seeing what returns equity is expected to give, what returns is fixed income market expected to give, what are the returns that any alternative assets can give us, and decide that based on the return and risk objectives and the capital market expectations, where should clients' money be invested such that all objectives are met. So once you have developed the strategy, implement the plan, that is actually purchase assets and invest the client's money, and monitor and update the strategy as to if it's performing up according to expectations, if investor circumstances have changed, if there is any tweaking or any realignment of the portfolio that needs to be done. So at level 1, it's a very naive level of or rather, we will not go into too much detail of the portfolio management process. Level 3 is all about portfolio management. Roughly 70% of the curriculum deals with portfolio management. So we will revisit all these topics in a lot of detail when we reach level 3. However, let's return our attention to the investment policy statement. There are two objectives that we need to quantify. First is the return objective, that is what is the return that the client needs. The return objectives will come from the aspirations and the requirements of the client in the future. So he wants to save money for his children's education. He wants to save money for his daughter's marriage. He wants to save money for funding a vacation or buying a house. Depending on what his aspirations are, we need to define what return the portfolio needs to generate such that clients' aspirations can be met. However, normally aspirations will be very high such that the return requirement from the portfolio will be very high, and the risk tolerance may not be as high. So risk tolerance looks at the fact that in case the portfolio suffers a loss, how detrimental will it be to the circumstances of my client? Does my client have enough reserves and enough other sources of income such that even if there is some loss, that the client will be able to recoup the loss? Or can the portfolio allocation be risky, or should it be less risky or be more conservative? So if the client does not have many other sources of income, if his risk tolerance is not very high, then even though the return objectives may be very high, you may need to counsel your client that you cannot take too much risk. Hence, you should revisit your aspirations with the level of portfolio that you are carrying. This is a good target for return, and this is a good target for risk that we should be carrying, and hence this is what we can be looking at in the long term as generating out of the portfolio. So Return objectives and risk tolerance will come from the personal circumstances of the client. Once you have fixed on the return and risk objectives, you will go and look at the constraints on the portfolio. Constraints are broadly categorized in 5 heads, namely liquidity constraints. So liquidity constraints tell us, is there any immediate requirement for cash that is going to come now or in the near future. So if he has to repay a loan next year, then you should strip off that much money from the portfolio, as that much money will not be available for investment. It will have to be repaid next year for the loan that the client had taken earlier. So whatever is the portfolio value, you should keep that much money separate. Or if there is any pre-committed cash requirement or any defined cash flow from the portfolio that is going to happen in the future, then that represents a liquidity constraint, as you cannot invest the money in illiquid securities because this much money is going to be required by the investor in the future. Normally, every investor will have 2 time horizons, in the case of individual investors, that is. One is pre-retirement, another is post-retirement. So time horizon is any period after which the characteristics of the portfolio are expected to change significantly. So pre-retirement, the portfolio can be more aggressive as the client is having sufficient supplemental income, whereas post-retirement, the portfolio has to be invested in less risky securities, since the returns of the portfolio is what the client is going to use for his living expenses. So time horizon is when the characteristics of the portfolio are expected to change significantly. Individual investors are normally taxable, so tax concerns are important. You need to minimize the tax liability for your client. Legal and regulatory factors are not very important for individual clients, however they become quite important for institutional clients. Any constraint that cannot be put under the 4 heads that we discussed is put under the head of unique needs and preferences. So a good example of unique needs is the client saying that do not invest my money in liquor companies, or do not invest my money in polluting companies. So any unique preference or unique requirement that the client may have will be documented under this head. So you decide the risk and return objectives and the investment constraints. So this will complete the investment policy statement. It is a good statement. It serves as a guiding tool for the fund manager. It helps resolve conflicts between the advisor as well as the client, and if any point in time the advisor needs to change or the fund manager needs to change, then the new fund manager does not have to start from scratch. He has this policy document as a guideline to begin from. The return objectives are broken down into 4 parts. They can be of capital preservation. So if the client says that my return objective is capital preservation, that means I'm not too ambitious, I don't want too much growth in my money. My savings should just beat inflation, or the purchasing power of my capital should be preserved. So capital preservation is a less risky strategy. It means I only want to beat inflation, I don't want any excessive growth. Normally for old investors and for investors who do not have significant capital commitments in the future, a capital preservation strategy is preferred. Capital appreciation is a strategy which asks the advisor to not only maintain the purchasing power but also create growth in the portfolio. So young investors who have ambitions of purchasing a house in the future or purchasing a car in the future would not just need savings, they would also need growth, as without growth they will not be able to meet their objectives of purchasing a house or making other big ticket investments. So capital appreciation means we want growth. current income return requirement means that the portfolio is used to supplement the living expenses of the client. So the income from the portfolio is very important because he is living on that income. So a current income requirement will be met by investing more in high dividend paying stocks, fixed income securities, instruments that give income, that give dividends, that give cash flows in the interim, which the client can use to meet his living expenses. A total return strategy would be a mix of both. So a total return strategy would concentrate on income as well as some appreciation. So it's a medium risk strategy which gives both income as well as appreciation to the client. Now, it has been seen that in the long run, the biggest decision that you can take for your client is the asset allocation decision. We studied this concept in the theory of efficient markets as well. Asset allocation decision is essentially, if you have $100 to invest, how much should you invest in equity and how much in debt? This is the most important decision that determines portfolio returns over the long run. So, in one case, if you take the decision of 70% equity and 30% debt, then this is the biggest call that you can take. After which, deciding which equity to invest in and deciding which exact debt instrument to invest in makes little difference. So if I have two portfolios, or let's say I have three portfolios. Portfolio A has 70 debt, 30 equity. Portfolio B has 30 equity and 70 debt. Portfolio C also has 70 equity and 30 debt. However, the 70 equity and 30 debt is some different instruments. So even in equity, I have an option to invest in different stocks. So they have different instruments than portfolio A. Research has shown that 90% of the variation or the volatility of a single portfolio over time, that 90% of the difference between portfolio A over different years, in year 1, year 2, year 3, will be explained because of this 70 equity and 30 debt decision. Had the decision been 30-70, the volatility of returns may have been very different. So, both portfolio A and C will have similar volatility. To the extent of 90%, their volatility will be different. It will be similar. So if A has 100% variation in return, even C will have a variation of about 90% to 110%. Why? Because it is seen that most equity investments and most debt investments will move in tandem. The biggest decision that you take is how much debt and how much equity to take. Asset allocation explains 40% of the variation in returns across funds. So across funds, a major chunk of the difference in returns will be explained because of the difference in debt and equity. A very small percentage of the difference in returns will actually be ascribed to timing the market or to which equity did B buy and which exact stock or which equity did A buy. The biggest difference in funds comes because they have a different asset allocation and A has a different asset allocation. So asset allocation is the most important decision that you will take for your client. Now, none of the investors individually have the capacity to decide the risk-free rate. Do you think any of you can decide the risk-free interest rate in the economy? Can one individual investor decide the risk-free rate? No. But all investors can decide their indifference. What is the meaning of indifference? I can't decide the risk-free rate. The risk-free rate may be 4%, it may be 5%, it may be 6%. But if the risk-free rate is 4%, can I say that is for taking no risk, I am getting a return of 4%. Then for taking 2 units of risk, I will want at least a return of 5%. And for taking 4 units of risk, I will at least want 6% return. And for taking 6 units of risk, I will at least want 10% return. So investors can't decide the risk-free rate, but every investor can decide his or her indifference. If the risk-free rate only is 6%, that is for taking no risk, I am getting a return of 6%. Then for taking 2 units of risk, I will demand at least 7% return. For taking 4 units of risk, I will demand at least 8% return. For taking 6% risk, I will demand 12% return. I'm saying that none of us can decide the risk-free rate, but can all of us decide our indifference? That if the risk-free rate is so much, then for taking a risk, I will want at least this much return. So all these 3 curves are indifference curves for the same investor. The same investor comes and says that if for taking no risk, I am getting a return of so much, then for taking a risk, along this curve I am indifferent. Along this curve, what I feel is that the additional risk is compensated by additional return. So along this curve, I am indifferent between investing because I feel the additional risk has been compensated for by the additional return. Tell me, if the curves that we have drawn are the curves for investor A, and the curves that I am drawing now are the curves for investor B, which investor is more risk-taking? Investor A or investor B? For investor A, for taking 1 or 2 additional units of risk, what is the additional return that I have to promise? Very high. I have to give so much extra return for him to take additional risk. Whereas look at investor B, even if I give a slightly higher return, even if I give a slightly higher return, that is from here to here, he is willing to take the additional risk. So investor B is a risk-seeking personality. As long as you give him a little bit of extra return also, he will undertake the risk. Whereas investor A is a risk-averse personality. For him to take additional risk, you have to give him a lot of additional return. Investor B is risk-seeking. So the more flat the curves, the more risk-seeking the personality. The more steep the curve, the more risk-averse is my investor. These are personality traits. All of us have different indifference curves. We have different points at which we will take higher risk. Before we study the theory of portfolio management as given by Henry Markowitz, there are certain assumptions about capital markets that we need to memorize. So before Henry Markowitz gave his theory of portfolio management, he made certain assumptions about assets and about the markets. First one was that the returns distribution is known to all investors. That is, all investors know the expected returns from all stocks, and they have the same expectation of expected returns from all stocks, and they also know the standard deviation. If they know the returns distribution, they know the expected value as well as the standard deviation. So they know the risk as well as return from all stocks, and they agree upon the risk and return, and they all have the same view of risk and return from all stocks. All investors exhibit utility maximization. That is, the indifference curves exhibit diminishing marginal utility of wealth. You see that the indifference curves are steep, or the indifference curves are upward sloping. That is, they're not a straight line. The indifference curves are not a straight line. They're not like this. So what does that represent? That for taking 2 to 4 units of risk, the investor is willing to, even if you give him a slightly higher return, he is satisfied. Whereas if you want him to take from 4 to 6 units of risk, that is, for an additional 2 units of risk, he would want a disproportionately higher return. That is, risk has diminishing marginal utility. If you want my investor to keep on taking more and more risk, then he will want a disproportionately higher return to take on the risk, because he doesn't want it. First few units of risk he'll take. It's okay. He'll be, as long as he's getting a slightly higher return, he'll invest in AAA rated bonds or AA plus rated bonds. But if you want him to invest in speculative grade securities or securities which have too much risk, then he will want disproportionately higher returns. So indifference curves are not flat. They exhibit diminishing marginal utility of wealth, or they are convex in nature. Risk is given by standard deviation, that is, risk is given by variability. All decisions consider only risk and return, and investors are risk averse, which means for a given amount of risk, they will ask for the highest return, and for a given amount of return, they will ask for the lowest risk. So investors are risk averse. We know from the chapter on probability that expected returns from a portfolio or expected returns on an asset can be computed as the weighted average of the individual returns. So let's compute the expected return for this asset. There's a 25% that the economy will be in an expansion. If the economy is in an expansion, the stock is expected to give a return of 5%. There's a 50% chance that the economy will be normal. If the economy is normal, the stock is expected to give a 15% return. There's a 25% chance of a recession. This stock actually gives a very high return in the case of a recession. It will give you a 25% return in the case of a recession. What are the expected returns from the stock? It will be probability of expansion into the return in the case of expansion, probability of normal return into the return in the case of a normal economy, the probability of recession into the return in the case of recession. Take the product and take the sum. It's called taking the weighted average. So the expected return from the portfolio is 15%. So that's how we'll compute the expected return from an asset. Once you have computed the expected return, can you compute the standard deviation as well? Standard deviation is the square root of the variance. Variance is the average of the square of the deviations. So what is the deviation of the first asset from the mean? It is 5 minus 15 minus 10. What is the deviation of the second asset? It is always the value minus the mean. Please look at the video on statistics, that is the second lecture, and understand this concept if you have any doubts. The third value has a deviation of 10% from the mean. So this is what deviations are. What is the variance? Variance is the square of the deviation averaged. So take a square of all these values. 100, 0 and 100. And then you need to take an average. Had the probabilities not been given, I would have taken a simple average. That is, I would have given an equal probability to each. I would have just divided all by 3, sum them up and divide by 3. But if the probabilities are given, then you take the products with the probability and you sum them up to compute your average. So it will be 0.25 into 100, 0.5 into 0 and 0.25 into 100. This will give the variance. This will give the variance of the asset. Take the square root of the variance, we will get the standard deviation. So variance is the average of the squares of the deviation, and standard deviation is the square root of variance. So in the previous question, the deviations are 10%, 0% and 10%. Square the deviations, we'll get 0.01, 0 and 0.01. Take the product with the probabilities, sum it up, and you will get the variance. It comes out to be 0.0050. Standard deviation is the square root of the variance. It will come out to be roughly 7% for the stock. So that is how investors compute the risk, that is the standard deviation and the expected returns from each asset. Markowitz assumed that all investors have the same expectations of risk and return. An investor holds the following portfolio, which is invested in 3 stocks: Able, Baker and Chuck. He owns 15,000 shares of Able, which has a share price of $20. He owns $10,000 in Baker, which has a share price of $30, and $40,000 in Chuck, which has a share price of 10 euros. I'm sorry. The expected return is 8%, 10% and 12% from the 3 stocks. Compute the expected return of the portfolio. The expected return on the portfolio is computed as the weighted average of the individual stocks. What are the weights? Weights are the proportions by market cap of each stock that you own. So what is the weight of Able? It will be 15,000 into 20 divided by the total value of the portfolio. Total value of the portfolio will be computed as the product summed up. That is the value of each stock. So 15,000 into 20 divided by the value of the portfolio will be the weight of A. Similarly, you can compute the weight of B, that will be 10,000 into 30 divided by the total value, and the weight of C, which will be 40,000 into 10 divided by the total value of the portfolio. Once you have the weights, you multiply 8% into the weight of A plus 10% into the weight of B plus 12% into weight of C to compute the expected return of the portfolio. So A is 300,000, Baker is 300,000 and Chuck is 400,000. Total portfolio value of 1 million euro. So what is the weight of A? 30%. The weight of B? 30%, and the weight of C is 40%. So the expected return on the portfolio can be computed as 0.3 into 0.08 plus 0.3 into 0.1 plus 0.4 into 0.12 or 10.2%. Now, oftentimes our view on two assets is such that they move together or inversely with each other. So if I have company A, which is a steel company, and I have company B, which is a coal company, what would I normally expect? When company B does well, that is when coal prices go up, what should happen to company B, or rather to company A? Coal goes in as an input in the production of steel. So coal is used to heat iron ore, which creates steel. So if coal prices go up, that means what is likely to happen to the profitability of steel companies? It is expected to go down. So if the profitability is expected to go down, then the stock should underperform or the stock should go down. So when stock B goes up, our view is stock A should go down. Now intuitively this looks correct. However, what may be happening is that when coal prices go up, it's because the demand in the economy is very good or economy is doing well. So steel prices also go up, and steel prices go up by even higher than the coal prices. So even the raw material costs go up, but the end product prices go up by even higher, such that you're actually making a higher profit. So when coal is going up, steel also goes up. It's possible. In order to check my view, should I have a tool that will help me analyze historical data and try to come to a conclusion whether coal stocks and steel stocks historically have moved together or have they moved inversely with one another? That statistical tool is called covariance. Covariance is defined as the average of the product of the deviations of two variables. So I'll have a variable A and a variable B. I'll take the deviations of variable A and the deviations of variable B. I'll take the product and I'll take their average. If my data is a sample, then I'll take the average as divided by n minus 1. If it is a population, then I'll just divide by n to compute the covariance. If the covariance comes out to be positive, then I will say that my variables move together. If the covariance comes out to be negative, then I can say that the variables seem to be moving in opposite directions. If the probabilities are given, then I will multiply by the probability to compute the average. If the probabilities are not given, then I simply divide by n or divide by n minus 1 to compute the average. So let's look at two stocks and let's try to compute the covariance between them. So when stock 1 gave a return of 10%, stock B gave a return of 20%. When stock 1 gave a return of minus 15%, stock B gave a return of minus 20%. When stock A gave a return of plus 20%, stock B gave a return of minus 10%. So on and so forth. First, let's compute the mean of A, that is sum them up and divide it by 6, it will come out to be 5%. Take the mean of B, that is sum all the values of B and divide by 6, so the return on B comes out to be 10%. take the deviation of each of the values from the mean. So deviation of the first value is what? It is 0.1 minus 0.05 or 0.05. Remember, deviation is always the value minus the mean. Take the deviation of the second value from the mean. Essentially what he says is subtract 0.05 from all values. And for stock 2, subtract 0.10 from all values. This will give you the deviations of stock 1. This is the deviation of stock 2. The next step in computing the covariance is take the product. Take the product of the two deviations. You've computed the deviations. You see that they are both moving down also together. When this gives 15%, this gives minus 20%. Hence, the product of the deviations is becoming positive. So take the product of the deviations and then take the average. That is, sum all these up and divide by n minus 1 because the data is a sample. So the covariance comes out to be 0.0510. Now the covariance number is come out to be positive. So I can say that the variables seem to be moving in the same direction, or they seem to have a positive relationship. But guys, is the covariance number of 0.051 very high or is it very low? Can I make that statement? Covariance theoretically can vary from minus infinity to plus infinity. So whether a number of 0.05 is high or low, I cannot say. Whether 10,000 number is high or low, I cannot say. It all depends on the scale of the data that I'm talking about. In this case, my data is in percentages, so it's 10%, 15%. Actually, the number of 5.1% is pretty high, or 0.05 is also pretty high. Whereas, if my data was the millions of barrels of oil production, 10 million, 20 million, that was the data on a yearly basis, then a number of 0.051 would have been very small. So to make an absolute statement from the covariance number is very difficult. I can say it's a positive relationship, but is it a strong positive relationship? It is not a very strong positive relationship. I cannot say with the help of covariance. So I scale down the covariance to compute something called as correlation. Correlation is covariance divided by the product of the standard deviations. Covariance is, or rather correlation is always a number between -1 and +1. So the correlation will come out to be in between -1 and +1. If the relationship is very strong, positive, it will come out to be close to +1. If it is a strong negative relationship, it will come out to be close to -1. If there is no relationship, correlation will come out to be close to 0. Now, a correlation coefficient of plus, just take the definition of correlation, please. You have to memorize this definition. Correlation measures the strength of the linear relationship between two variables. Correlation measures the strength of the linear relationship between two variables. A correlation coefficient of +1 will mean that there is a strong positive linear relationship. That means the relationship between A and B is something like y is equal to 4x, or B is equal to 4a, y is equal to 28x. All such relationships will have a correlation coefficient of +1. If the relationship was something like y is equal to -12x or y is equal to -200x, then the correlation coefficient would come out to be, for both these series, the correlation coefficient will come out to be -1. Why? It's a strong negative linear relationship. A number of -1 means that returns move proportionally in the opposite direction. They are perfectly negatively correlated. A correlation coefficient of 0 means that there is no linear relationship. All it means, guys, is there is no linear relationship. There may be a quadratic relationship, but that is not captured in correlation. Correlation will only tell you the strength of the linear relationship between two variables. So if correlation is 0, that means there does not appear to be any linear relationship. It's possible that there is actually no relationship between the variables, or it's possible that the relationship is not linear, however it's a quadratic or a logarithmic relationship. So y is equal to x square or y is equal to log of x, something like that. So this will not be captured in correlation. We will have to apply some other tools to compute this relationship. Correlation measures the strength of the linear relationship between the two. It is computed as the covariance between the variables upon the product of the standard deviations. So let's look at the previous example and compute the correlation between the two stocks. The covariance between the returns on the two stocks in the previous example was 5.1%, and the standard deviation of returns for the two stocks was 22.36% and 32.25% respectively. Calculate and interpret the correlation between the two assets. Correlation is equal to covariance upon the standard deviation of one multiplied by the standard deviation of the second. So the covariance between the two assets is, remember, it was 0.051 or 5.1% divided by the product of the standard deviations, or 0.2236 multiplied by 0.3225. So it comes out to be equal to 0.7072. So a correlation number greater than 70% can normally be said to be a high correlation. So even though the covariance number was just 0.051, when we computed the correlation, we found that the correlation is 0.7. The maximum value of correlation can be 1. So it's a strong positive correlation. However, it's not a perfect linear relationship. So they're strongly positively related, however they're not perfectly linearly related. So this kind of analysis can help us evaluate our intuition about stocks, that we feel that the two stocks may move together, we may feel that the two stocks may move negatively. We can do this analysis and check whether our intuition has historically been correct or wrong. The correlation between the returns on two stocks is 0.56. Their standard deviations of returns are 15.44% and 8.92%. Calculate and interpret the covariance between the two assets. Correlation is equal to covariance upon sigma 1 into sigma 2. So covariance will be given as correlation into sigma 1 into sigma 2. The correlation coefficient is 0.56. The standard deviation of 1 is 0.1544. The standard deviation of the second is 0.0892. So the covariance between the two assets can be derived from this formula. It comes out to be 0.0077. So you understand, guys, even though the covariance or the correlation was 0.56, covariance number came out to be so small. Now what can you say from covariance? Is it a strong positive relationship? Is it a strong negative relationship? I can say it's a positive relationship, it's not negative. But can I say is it strong or not? Not really. I don't know whether this number is high or low. That is why I need to compute correlation. Correlation will tell me if the relationship is strong or not. Now, the expected return of a portfolio was calculated as the weighted average of the two. So W1 into sigma 1 plus W2 into sigma 2 was the expected return on the portfolio. Sorry, sigma is the standard deviation. W1 into R1 plus W2 into R2, that is the weight of the second stock into the return on the second stock, was the expected return. Let's look at the example again. Let's assume that stock 1 was company A, that is our steel company, and stock 2 was company B. Actually, our view was correct. When B does well, A actually goes down. I did the correlation analysis and the correlation number came out to be minus 0.7. Correlation between A and B came out to be actually minus 0.7, indicating a strong negative relationship, that when coal stocks do well, steel stocks perform badly, and when coal stocks do badly, that is coal prices fall, steel stocks do well. Individually speaking, both company A and company B are very risky. Company A is a commodity, company B is also a commodity. There's a lot of fluctuation in prices and they both have a very high standard deviation. Sigma A and sigma B are both very high. This is about 25%. The coal company has even higher, it is about a 30% standard deviation. Individually speaking, both are very risky. Tell me, if I hold both A and B in a portfolio, however, will my portfolio also be very risky, or will my portfolio be less risky? Will my portfolio simply be WA into sigma A plus WB into sigma B? Or will the portfolio be less risky than this? Remember, the portfolio standard deviation will not be simply the weighted average of the individual securities. Why? Because there is a negative correlation between the two. Individually they may be very risky, however in combination they are very less risky because they always move against each other. So when A moves up, B falls, and when A falls, B moves up to cushion the impact of the other. So whenever any one stock falls, the other stock rises to cushion the impact of the fall. So what the combination of the two assets does is, it reduces the risk of the portfolio from simply a weighted average submission. So this will not be the risk of a portfolio. To compute the risk of a portfolio, we need to take the covariance or correlation between the assets into account. So the risk of a portfolio for a two-asset portfolio can be computed as W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 covariance of 1, 2. 2 W1 W2 covariance of 1, 2. Covariance can also be written as correlation into the product of the standard deviations. Please watch the video on quantitative analysis again. We have given the matrix approach on how to remember these formulas for 2 asset, 3 asset, even 4, 5 asset portfolios. You will see the matrix approach on how to remember these formulas in that video. If it is a 3 asset portfolio, then the risk of the portfolio will be given as W1 square sigma 1 square plus W2 square sigma 2 square plus W3 square sigma 3 square, 2 W1 W2 covariance of 1, 2, 2 W1 W3 covariance of 1, 3, 2 W2 W3 covariance of 2, 3. Covariance can always be written as correlation into sigma 1 into sigma 2. Please look at this formula. Please look at this formula. Tell me, for what value of correlation will this become W1 sigma 1 plus W2 sigma 2? For what value of correlation will this become the weighted average of the individual risks? If correlation is 0, this will become W1 sigma 1 square plus W2 sigma 2 square. Is this equal to W1 sigma 1 plus W2 sigma 2? If correlation is 0, then this term will go away. It will just become this. This is not equal to W1 sigma 1 plus W2 sigma 2. The formula for A plus B whole square is A square plus B square plus 2AB. If A is W1 sigma 1 and B is W2 sigma 2, this formula will become A square plus B square plus 2AB only if the correlation is 1. Only if the correlation is 1, that this formula will become W1 sigma 1 plus W2 sigma 2. What is the maximum value of correlation? What can be the maximum value of correlation? It can be +1. So you understand that the weighted average risk can be the maximum possible risk of the portfolio. So the maximum possible risk of the portfolio is W1 sigma 1 plus W2 sigma 2 when the correlation between the two assets is exactly equal to +1. For all other values of correlation, the risk will be lesser than the weighted average of the two. This phenomena is called diversification. That if you invest in more than one stock, then your risk is lesser than the weighted average summation of the risks, unless the correlation is 1, which is an extreme value. So for all other values, the risk will be less than this value. We will study the concept of diversification better in the coming slides. Knowing this formula, let's imagine a portfolio that consists of 2 assets. There is one asset called Caffeine Plus and there's another asset called Sparkling. Caffeine Plus has an expected return of 11% and Sparkling has an expected return of 25%. The standard deviation of Caffeine Plus is 15% and the standard deviation of Sparkling is 20%. The correlation between Caffeine Plus and Sparkling is 0.3. The correlation between Caffeine Plus and Sparkling is 0.3. Compute the expected return and expected risk of a portfolio that consists 60% of Caffeine Plus and 40% of Sparkling. So a portfolio consists 60% of Caffeine Plus and 40% of Sparkling. Compute the expected return and the expected risk of the portfolio. The expected return is simple, it is just a weighted average. It will be 0.6 into 11 plus 0.4, that is the weight of sparkling, into the expected return of sparkling, which is 25. Please compute. This sum will come out to be 16.6%. This will be 10%, and this will be 0.066, 6.6%. So the sum will be 16.6%. Compute the expected risk of the portfolio. Expected risk from the formula that we studied earlier will be given as W1 square sigma 1 square plus W2 square, 40% is the weight of the second asset, sigma 2 square plus 2 W1 W2 correlation into sigma 1 sigma 2. Sigma 1 is 0.15, sigma 2 is 0.2. If I do this calculation, I will get the expected risk of the portfolio. Expected risk of the portfolio will come out to be 13.7%. So this was the case when caffeine plus was 60% in my portfolio and sparkling was 40% in my portfolio. Can I compute the expected risk and return of my portfolio under various circumstances? So if I had 100% caffeine plus and 0% sparkling, then what would be the risk and return? It would be the same as that of caffeine plus. It would be 11% expected return and 15% expected risk. If I had 20% caffeine plus and 80% sparkling, could I apply the same formula in the same manner and compute the expected return and expected risk? So I can create infinite different portfolio combinations by weighting the assets in a different manner. I can have 14.5% of caffeine plus and 86 or 85.5% of sparkling. So I can have different weights of the two assets and compute different portfolio or different asset combinations and different portfolios by the combination of these two assets. So this table represents a few of the combinations that I have created by weighting the assets in different proportions. Now tell me, between portfolio A and portfolio B, which portfolio will you invest in? Between portfolio A and portfolio B, given the Markowitz assumptions, remember the Markowitz assumptions, and answer which portfolio is an investor likely to invest in? Portfolio A or portfolio B? Investors are risk averse. For the same risk, they will want higher return, and from the same return, they will want lower risk. So investors are more likely to invest in portfolio B because for the same risk, portfolio B is giving a higher return. Similarly, between portfolio B and portfolio C, which portfolio will you invest in? Between portfolio B and portfolio C, which portfolio will you invest in? You will invest in portfolio B because it is giving you a higher return for a lower risk. It is giving you 16.6% return for a 13.7% risk. And portfolio C is giving you only 11% return for a 15% risk. So the different portfolio options that I have created, A, B, C, D, E, F, G, H, I can weight the assets differently and construct many different portfolio options. and I can plot them in a graph with return on the y-axis and risk on the x-axis. So the expected return from the portfolio is on the y-axis and the expected risk from the portfolio is on the x-axis. Now tell me, will a rational investor or will a Markowitz investor who follows the Markowitz assumptions invest in any portfolio below the purple line that I have drawn? Will he ever invest in any of these portfolios? No, because there is another portfolio available which gives a higher return for the same risk. So, for any of the portfolios along this purple line, there will be another portfolio available that will give me a higher return for the same amount of risk. So I will never invest in any portfolio below this purple line. I will only invest along the black line that is remaining. This black line is called the efficient frontier. This black line is called the efficient frontier. For the purpose of illustration, I took just two assets, Caffeine Plus and Sparkling. In the real world, I have thousands of assets available. In the real world, I have thousands of assets available. I can have thousands of millions of different combinations of portfolios. So actually speaking, I'll have millions of different portfolio combinations. When I take the correlations into account and I try to compute the different possible risk and return. Again, will I invest in any of these purple portfolios? There will be infinite such portfolios in the real world when I consider all my infinite assets. But will I invest in these purple portfolios ever? These are all different portfolio options. No, because for every purple portfolio, I have a black portfolio or a portfolio along this black line which gives me the highest return or a higher return for the same amount of risk. For the same amount of risk, it gives me the highest return. So these portfolios are called efficient portfolios. Portfolios along this black line are called efficient portfolios. They give us the highest amount of return for a given amount of risk. Please note, there is one assumption in this analysis. In the analysis earlier also, in this slide also, and even in this slide where I considered all the assets of the world, there is one assumption. Can you point out the assumption? Assumption is that there is no risk-free asset available. So all assets have some risk. There is no asset which gives me a return for zero risk. If there was any such asset available, then there should be some point here, there should be some point on the y-axis that if I invest 100% of the money in that risk-free asset, then there will be zero risk and there will still be some return. So the Markowitz efficient frontier is defined for a portfolio of risky assets. That is, there is no risk-free asset available. which is not a correct assumption, because in the real world we do have risk-free assets available. Government securities, government bonds are considered risk-free. Now tell me that which portfolio along this efficient frontier will you actually invest in? We have proved that the investor will only invest along this efficient frontier. Why? Because all other portfolios will have another portfolio which gives a higher return for the same risk. So I will never invest in any of the purple portfolios. I will only invest in one of the black portfolios. But the question asked is, which black portfolio will you invest in? All these black portfolios are efficient. Efficient means there is no other portfolio which gives a higher return for the same risk. So all these black portfolios are efficient. That is, for their level of risk, they give the highest return. If you want an even higher return, you will have to take on more risk. If you want even higher return, you will have to take on more risk. Now the question is, which black portfolio will an investor invest in? That will depend on his risk tolerance. That will depend on his indifference curves. So investor who is less risky or more risk averse, who has steeper indifference curves, will choose a less risky portfolio. Whereas an investor who has more flatter indifference curves or is more risk seeking will choose a more risky portfolio. So investors will choose the portfolio that is tangent to their indifference curves. For a less risky investor, the tangency portfolio will fall lower down. For a more risk-seeking investor, the tangency portfolio will figure higher up. So depending on your personality, depending on whether you are a risk-seeking guy or a risk-averse guy, will decide which point on the efficient frontier do you lie. So investor I1 or I dash is a risk-seeking investor. Investor X or other investor I is a risk-averse investor. His are more steeper, his indifference curves are more steeper, so his tangency portfolio or indifference curve is tangent at a lower point. He will invest or he will choose a less risky security. Investor I dash has flatter indifference curves. He is more risk seeking, so he will be higher up on the efficient frontier. He will invest in a portfolio that is more risky. Remember, the assumption here is that a risk-free asset is not available, that there is no risk-free asset available. This is an incorrect assumption because in the real world risk-free assets are available. In the coming slides, we will make a risk-free asset available and see how does the risk-reward profile change. So we'll move on to asset pricing models, where we will relax this assumption of no risk-free asset available. We will actually include a risk-free asset in our analysis and see how the risk-reward profile changes. However, before we move on to asset pricing models, there are certain more assumptions that we should be aware of. So the capital market theory that we are going to study in the coming slides has the following assumptions. These assumptions are important. They are very directly tested. So you have to remember these assumptions. So he starts that all investors are Markowitz investors. So all the previous assumptions that we studied also are valid here. That is, they are risk averse, they have diminishing marginal utility of risk, and they know the returns distribution, and risk is variability, or risk is standard deviation. Furthermore, the capital market theory assumes that unlimited risk-free lending and borrowing is allowed. So I can borrow also as much money as I like, and I can lend also as much money as I like at the risk-free rate. Does this actually happen? No. Actually, I borrow at a higher rate and I lend at a lower rate. But the assumption is that unlimited borrowing and lending can happen at the same risk-free rate. All investors have the same expectations of risk and return. So all investors have the same expectations from all assets about their risk and return and the correlation amongst them. All investors have a 1 period horizon. Assets are infinitely divisible. That is, if I want, I can even buy half a share. In the real world, it's not possible. But in the capital market theory assumption, we will assume that I can buy a share with as much money as I have. Even with 1 rupee, I can buy a share. So the share costs 1,000 rupees. I can buy 1/1000th of the share. Assets are infinitely divisible. Markets are frictionless, that is, there are no brokerage costs, there are no transaction costs, there is no inflation, and interest rates are constant. So risk-free rate is constant, it's not varying. And markets are in equilibrium. It means all assets are fairly priced at the moment. There is no arbitrage opportunity. There is no undervaluation or overvaluation. All assets are fairly priced. Under these assumptions, the good part is at least a risk-free asset is available now. Under these assumptions, let's try to compute the expected return on different portfolios. Let's try to compute the expected return on different portfolios. So we begin with our efficient frontier that we derived using the Markowitz analysis. So we derived the efficient frontier, this black line. However, we now also introduced a risk-free asset. So a risk-free asset is also available now. Let's assume that I choose any portfolio on the efficient frontier. Let's assume I choose portfolio X. I put a weight of W in portfolio X, and I put a weight of 1 minus W in the risk-free asset. So what will be the expected return of my portfolio? Okay, I randomly chose X. There is no special reason why I chose X. Just let's assume I chose X, Y, anything I can choose. What will be the expected return on the portfolio? It will be W into the return on X plus 1 minus W into the return on the risk-free security or the risk-free rate. If this is the expected return on the portfolio, what will be the expected risk of the portfolio? Expected risk is given as W square sigma X square plus 1 minus W square sigma RF square, that is the risk of the risk-free security, plus 2W into 1 minus W into correlation into sigma X into sigma RF. Okay, all this is under the square root. By definition, what is sigma RF? By definition, what is the risk of a risk-free security? Zero. So this term will become 0 because there is a multiplication with RF. Even this term will become 0. So it will be Wx square sigma x square plus 0 plus 0. So the risk of the portfolio will simply be the weight of the risky security multiplied by the risk of the risky securities. So the expected risk of the portfolio will simply be the weight of the risky security multiplied by the risk of the risky security. From this, can you compute W? What will W be? W will be expected sigma upon sigma x. Expected sigma upon sigma x. Use this value of W from this equation and substitute it in equation 1. So first let me take W common. W common, this will become Rx minus Rf plus Rf. Can everyone imagine how this happened? We took W common from here. So W is common, Rx will come common from here, minus Rf will come common from here, and 1 into Rf will remain separate. Now substitute the value of W that you computed here into this equation. So expected return will become Rf plus expected sigma upon sigma x. That's what W is. W is expected sigma upon sigma x into Rx minus Rf. Into Rx minus Rf. So the expected return on my portfolio is equal to the risk-free rate plus the expected risk upon sigma x into Rx minus Rf. This equation between the expected return and expected risk of a portfolio is called the capital allocation line. This equation is called the capital allocation line. Please look back on the video and see how we've proved this. So this is the equation of this line. This is the equation of this line from X. Line that joins the risk-free rate to X. When the expected risk is equal to sigma x, what should be the expected return? Substitute expected risk as sigma x in this equation. Expected return will become Rf plus Rx minus Rf. It will become Rx. So if the expected risk is sigma x, that is, I have 100% weight in the risky asset, so my expected return will be the return on x. If the expected sigma is 0, that means I take no risk. If expected sigma is 0, then the expected return will become Rf. That is no risk, expected return is the risk-free rate. So you understand, this equation is the equation of this line. Now I will reach this point exactly. I will reach the return on the risky asset if I invest 100% of my money in the risky asset. If I invest 100% of my money in X, I will reach this point. How will I reach beyond X, or how or when will the expected return be greater than the return on X? That will happen when I lever. That is, I borrow at the risk-free rate and I invest the money in the risky portfolio. So I put a weight of 2 times on the risky asset and a weight of -1 in the risk-free asset. So I will reach some point here. To be at this point in the curve, what I'm doing is I'm putting some weight in the risky asset and some weight in the risk-free asset, which implies I'm lending at the risk-free rate. If I'm investing money at the risk-free rate, means I'm giving it to someone, and that someone is giving me the risk-free rate of return. That means I'm lending at the risk-free rate. So if I'm in this portion, then I'm lending at the risk-free if I want to increase my risk even higher than the risk of the risky asset, then what can I do? I can borrow money at the risk-free rate and invest it in the risky portfolio X, such that my risk will become even higher. My risk is equal to W times the weight, the risk of the risky portfolio plus W into sigma X. If W becomes 2, that is I put twice the weight in the risky asset, this will become 2X. But to put twice the weight in the risky asset, I have to borrow. I have to borrow minus 1 at the risk-free rate. So I have to pay someone the risk-free rate and I have to borrow money to increase my risk even more than the risky asset. So I can borrow, remember the first assumption of the capital market theory was unlimited risk-free borrowing and lending is allowed. So I can do unlimited amount of borrowing and invest it in the risky portfolio or the risky asset and create an unlimited amount of risk. So you understand how the investor can create a risk return profile along this line through X? That is by borrowing and investing in the risky portfolio X. Now when I started my analysis, there was no special reason why I chose the portfolio X. I just chose any portfolio on the efficient frontier. I could have very well chosen Y and does the same analysis. Would I have derived this equation? Would I have derived the equation through Y? Right now I've derived the equation through X. I could have very well derived the equation through Y. In fact, which set of portfolios is better? The ones on Y or the ones on X? Which give me a higher return for the same amount of risk? The ones on Y? So it would have been better had I created my line through Y. That is, I would have started off with the portfolio Y. In fact, what is the need to stop? You could have gone higher. There could have been a portfolio W that you could have chosen and you could have created an even better risk return profile. You could have gone all the way up to the portfolio M. The property of portfolio M is that it is exactly tangent to the efficient frontier. Is it possible for me to go above this? Is it possible for me to draw a line above the line passing through portfolio M? Can I create this kind of a risk return profile? No, I cannot, because there is no portfolio available. At best, I can keep going up, but I will stop at portfolio M because there is no other portfolio available for me to go even higher. So this line cannot be constructed because there is no risky portfolio available. Now tell me, once I have drawn the line through portfolio M, what is my efficient frontier? Is it the purple line? The purple line is the original efficient frontier, or is it the yellow line? The yellow line is the new capital allocation line passing through M. Is the efficient frontier now the yellow line or the purple line? The purple line was my original efficient frontier. The blue line is the portfolio combinations of risk and return that I have created by combining the risk-free asset with the tangency portfolio. So the yellow line is created by combining the risk-free asset with the tangency portfolio. Can you see that all portfolios along the yellow or fluorescent line, all portfolios along the yellow line give me a higher return for the same amount of risk than my efficient frontier. So all portfolios along the yellow line give me a higher return than the portfolios on the efficient frontier. Will I ever invest in the purple line now? Will I ever invest in my original efficient frontier? No, because I have another set of portfolios along this yellow line which give me a higher return for the same amount of risk, or a higher return for a lower risk. So the new efficient frontier is going to be the line through the tangency portfolio M. Remember guys, all these lines that combine the risky asset with the risk-free asset, all these lines are called capital allocation lines. They are called CAL, capital allocation line. The capital allocation line that passes through the tangency portfolio, this line that passes through the tangency portfolio is a special capital allocation line. It is called the capital market line. So capital market line is a special capital allocation line that passes through the tangency portfolio. You understand that this line passing through the tangency portfolio is giving me the best combination of risk and return. So if the investor wants to take some amount of risk, all he has to do is pick a risk-free asset and pick the tangency portfolio M and weight them in different proportions, probably borrow and invest in the tangency portfolio M, and that will create the best risk return profile for him. This investment will create the best risk return profile for him. So have we just proved that a rational investor or a risk-averse investor never has to invest in any portfolio except the risk-free rate and portfolio M. Because the best risk return profile can be created by investing in portfolio M and the risk-free rate. So an investor never has to invest in any portfolio except the risk-free rate and portfolio M. Portfolio M is also called the market portfolio. Portfolio M, which the investor will combine with the risk-free rate to create the best combination of risk and return, to create the new efficient frontier, is also called the market portfolio. So M is also called the market portfolio. Why is it called the market portfolio? Because portfolio M must contain some part of every investable asset. Why must it always contain some part of every investable asset? Let's assume it does not contain some asset X. Let's assume it does not contain emerging market equities. We have just proved that any investor has to only invest in the risk-free rate R and in portfolio M to create the best combination of risk and return. That is, the best combination of risk and return, which is the capital market line, can be created by investing in portfolio M and the risk-free rate. So no matter how much risk he wants to take, all he has to do is borrow at the risk-free rate and invest in portfolio M. So every investor in the world is only going to invest in some combination of M at the risk-free rate. So if portfolio M does not contain an asset X, then no one will invest in the asset X because he doesn't need to. The best combination can be created by M and the risk-free rate. So if it does not contain portfolio X, then nobody will invest in X. If nobody invests in X, what will happen to the price of X? Nobody wants to buy X. People only want to invest in other securities. That is, they want to sell X and invest in portfolio M. M does not contain X, so nobody will invest in X. If nobody invests in X, what will happen to the price of X? It will keep falling. Soon, X will give the best combination of risk and return, or X will start giving a better risk return profile than the other assets because its price has fallen so much. Hence, this situation is inconsistent. So, portfolio M must contain some part of every investable asset. Otherwise, people will never invest in that asset because they only need to invest in portfolio M and some combination of the risk-free rate. So, please remember this equation well. The expected return on a portfolio is given by the risk-free rate plus the expected risk on the portfolio upon the risk of the market into RM minus RF. We derived this equation with the help of X. We could have very well used portfolio M. The equation would have become expected return is equal to the risk-free rate plus expected risk upon sigma M into RM minus RF. This is called the capital market line. It is a special capital allocation line which passes through the tangency portfolio. The tangency portfolio is also called the market portfolio. It must contain some part of every investable asset in the world. Now guys, let's take an example of two companies, A and B. Company A is also a fashion designer and company B is also a fashion designer. Both are high-end fashion designers. Both are very good at their job. So A also designs high-end clothes, B also designs high-end clothes. Customers pretty much decide randomly between the two options. Some people go for A, some people go for B. Both of them are equally good at their jobs and there are only two high-end fashion designers in the country. Now I have 100 rupees to invest or $100 to invest. I have three options. In one case, invest the entire 100 in A. In the second case, invest the entire $100 in B. And in the third case, invest 50 in A and 50 in B. At the moment, the income statement of A looks something like this: 100 rupees of revenues, 50 rupees of costs, and 50 rupees of profits. Sales, costs, and profit. What do you think will the income statement of B look like? Both of them are equally good. It's just half the people go here, half the people go there. So even B must be doing sales of 100, costs of 50, and profits of 50. Tomorrow, let's assume that the economy goes into a recession. Economy goes into a recession such that people cannot afford high-end fashion anymore, and the demand for high-end fashion clothing falls. So earnings of A also falls and earnings of B also fall. Their costs remain as high. So A is making 80, 50 and 30 of profit, and even B starts making $80 of sales, $50 of costs, and $30 of profits. Now, in the first case, in a normal economy, what would your return on investment have been in all three cases? Let's assume this 100 is all that is required. So by investing 100, you would own entirely company A or company B. In case 1, what would your return have been in a normal economy? In case 1, you would have earned 50 rupees. In case 2, you would have again earned 50 rupees. Why? 100% in A. If you entirely owned A, you would have gotten 50 rupees. If you entirely owned B, you would have gotten 50 rupees again. If you owned half of A and half of B, what would your total return be? Half of A, 25 from A, and 25 from B. You would have made 50 rupees of return in all the three cases. So you understand, if the economy was normal, in all three cases, no matter how you chose to invest, 100 in A, 100 in B, or 50 in A and 50 in B, you would have gotten a return of 50% on your investment. If the economy falls into a recession, that is, people cannot afford high-end clothes, what would be the return in case A? It would fall to $30 or 30%. In the case of B also, the return would have fallen to 30%. In the case of C, wherein you get half of A and half of B, because 50 half of A you own and half of B you own, your return would have still been 30. So in the case of a recession, in all three cases, your return would have fallen down to 30%. If the economy went into a boom, that is, people suddenly demanded a lot more fashion clothing, and the demand for fashion clothing went very high, so that the returns of A also became $70, returns of B also became $70. Then again, what would your return have been in the three scenarios? In case of a boom, in scenario 1 also you would have gotten 70, scenario 2 also you would have gotten 70, and scenario 3 also you would have gotten 70. The phenomena that I have just explained is called market risk. Yes, this is the risk that cannot be avoided. Because these companies are in the business of fashion designing, this is the risk that they are willing to bear. That if the demand for fashion clothing falls, then both companies will bear a loss. The entire industry will bear a loss, It doesn't matter how you invest, whether you invest half the money in each or whether you invest the entire money in each. In all cases, your return will fall down to 30. Whereas, if the demand for fashion clothing suddenly becomes very high, that is, investors or customers all have very high disposable incomes and all decide to buy a lot of fashion clothes, then the demand for both A and B will go up. It doesn't matter if you invested entire money in A or entire money in B or half in A and half in B. In all cases, your return would have gone up to 70%. This is called market risk. It cannot be avoided. When a firm undertakes a business, this is the risk that you have to take. This is the risk that you have a comparative advantage in measuring and managing. This is why you make a profit or a company makes a return. So market risk or systematic risk cannot be avoided. Okay? Now let's assume that fashion designer A meets with an accident and she is not able to design clothes anymore. So A meets with the economy is still normal. The economy is normal. There is no recession or boom. But what has happened is that fashion designer A has met with an accident and unfortunately she can't work anymore. She can't design clothes anymore. People came to company A because of fashion designer A, and if fashion designer A is no longer there, then what will happen to the sales of company A? They will become zero. Costs will also be zero. They will have to fire everyone because there is no demand for their products. So the profit will become zero. Everyone imagines? If A meets with an accident, this is what is going to happen. However, just because fashion designer A has met with an accident, you think people's demand for fashion clothes is going to go away? Or people's demand for high-end fashion is going to go away? No, it won't. So what will they do? A is no longer there. They still need the fashion clothes because the economy is still normal. They still have the money. So what will they have to do? They will have to go to fashion designer B. Anyways, both of them were equally good. People were randomly deciding between A and B. So the sales of B will double. They will go to 200. Of course, he'll have to spend more on clothes and more on garments. So his costs will also go up. And his profits will also double to 100. Because fashion designer A has met with an accident doesn't mean people's demand for clothes is going to go. The market is still normal. The economy is still normal. So the sales that are lost in A will come to fashion designer B. So B will now make twice the products. So tell me, in this case, when fashion designer A has met with an accident, what will happen to the returns if you had invested in manner 1? Your returns would have become 0. Had you invested entirely in B, your returns would have doubled. Your returns would have become 100%. Had you invested in manner C, that is in the third way, the 50 that you invested in A would have become 0. But the 50 that you invested in B has become 100, so you will get half of it. You will still get 50, so you will still get 50% return. What was your earlier expectation of return? The earlier expectation with a normal economy was 50% in all three cases. You understand, if you invested in the third manner, that is 50% in A and 50% in B, even though company A has shut down, that is half of your investment became zero, still your return did not fall by any percent. Your return is still 50%, that is your return is still same as that of the earlier expectation with a normal economy and normal function. Why? Because market risk hasn't played out. The economy is still at the same level. This is called firm specific risk or unsystematic risk. Fashion designer A becoming disabled is firm specific risk or unsystematic risk or diversifiable risk. By investing in many securities or by investing in many stocks, you can diversify this risk such that this risk cannot cause a loss. Similarly, had something specific happened to fashion designer B, all sales would have come to fashion designer A. Your return would have still been 50%. So, firm specific risk is not a risk that a diversified investor has to bear. By simply diversifying his portfolio into many stocks, he can do away with that risk. Market risk he can do nothing about. Market risk cannot be diversified away. It will still remain. If the economy as a whole goes up or down, then it doesn't matter how you invest. 50% in A or 100% in A or 50% in A and B, your portfolio will fluctuate with the economy. So market risk, nothing can be done about. But systematic risk or firm specific risk is not a risk that an investor has to bear. Firm specific risk can very well be diversified away by investing in manner 3. That is by diversifying your investments in many stocks. This is the concept of diversification. So, if you have just one stock in your portfolio, the x-axis in this curve is the number of securities, and the y-axis in this portfolio is the total risk of the portfolio. So if you just have one stock in the portfolio, then the risk will be very high. Why? Because there will be systematic risk also and there will be firm specific risk also. However, as you add more and more stocks to your portfolio, the systematic risk you can do nothing about. The systematic risk will still remain. However, the firm specific risk will keep on becoming zero or will keep on reducing because diversification is happening. Even if anything bad happens to one company, it will simply mean that the sales will shift to the other company. So at an overall aggregate portfolio level, you will not lose because of firm specific factors. So unsystematic risk can be diversified away. It has been seen that if you have more than 30 stocks in your portfolio, if you have 30 different stocks across different sectors or different companies, then you have pretty much diversified away all the unsystematic risk of your portfolio. Your portfolio will only have systematic risk. So total risk, which is sigma. Total risk of a portfolio is what? It is the standard deviation. It is sigma, can be broken down into systematic risk and unsystematic risk. Systematic risk is measured by a term called beta, as we'll explain later, and unsystematic risk. The unsystematic portion of the risk, which is firm specific risk, can be made zero or can be totally diversified away. It can practically be made zero by holding a large number of securities in the portfolio or holding different stocks in the portfolio. This brings us to the capital asset pricing model. The capital market line or the Markowitz analysis said what? That expected return on the portfolio is equal to the risk-free rate plus expected sigma upon sigma of the market into RM minus RF. Please go back in the video. This is the equation that we just derived a few minutes back. But this was Markowitz analysis, which gave the definition of risk as total risk. In capital asset pricing model, we proved that the unsystematic or the firm specific component of the risk does not matter. So the expected return should not be given by the total risk. It should only be given by the part of the risk that I am actually bearing. A diversified investor only bears the systematic risk. A stock can have a very high unsystematic risk or a very high firm specific risk, but that is not a risk that my diversified investor needs to bear, because he can simply invest in many stocks and make that risk zero. So the capital asset pricing model says that the expected return on a security is the risk-free rate plus the systematic component of the total risk. The systematic component of the total risk is given by correlation coefficient multiplied by the total risk upon sigma m into RM minus RF. So the total risk which is given by sigma is broken into systematic risk, which is rho into sigma, and unsystematic risk, which is 1 minus rho into sigma. So 1 minus rho into sigma. The sum of this will become the total risk sigma. The unsystematic component of the risk does not matter, because in a diversified portfolio it becomes zero. So the capital market line has to be tweaked to the securities market line, which says that the expected return is equal to the risk-free rate plus the correlation into the expected sigma upon the sigma of the market. That is, it brings the factor of correlation. It says only systematic risk is what you need to worry about, not the total risk. Don't worry about total risk. You should only multiply the risk premium by the systematic risk. This term, that is correlation into expected sigma of the portfolio upon sigma of the market, is also called the beta of the portfolio. So this gives us the capital asset pricing model, which says that the expected return is equal to the risk-free rate plus beta times RM minus RF. Beta is correlation into sigma of the portfolio upon sigma of the market. It can also be written as covariance of the portfolio with the market upon the variance of the market. This is the same formula. If I substitute the formula of correlation is covariance upon sigma into sigma, I will get this formula. So beta is given as covariance upon variance, or correlation into sigma p upon sigma m. So the capital asset pricing model says that in a diversified portfolio, the expected return from a new asset will not be given by its total risk as said by the capital market line. This is what the capital market line said. that it will be the total risk multiplied by Rm minus Rf by sigma m. It says that the expected return will only be given by the systematic component of risk, or you need to multiply this by correlation, such that the expected return according to the capital asset pricing model is the risk-free rate plus beta times Rm minus Rf. Beta is also called the sensitivity of the stock returns to the market returns. Are you all sleeping, guys? How long does it take to do 3 upon 25? Mukta, Divya, Hital, Ajit. Just 5 more minutes, guys. Keep your calculators out, do all the calculations. 5 minutes will be done. These questions are important, they will be asked in the exam. And so you've covered about 60-70% of your syllabus now. We'll start off with fixed income securities in the next class. It's a difficult topic. Make sure you attend that class. And please practice questions on portfolio management from your question bank and do the test papers now. You have your test papers in your inbox. Please do all your test papers. They have tough questions. They have very good questions. Okay. So we meet on Wednesday now. When is the next class? Wednesday 7:30. Divya, you normally don't come for weekday classes. Make sure you come for that class. Okay. Even if you have to take leave or if you have to miss some bit, please do that. Oh, it's 8 p.m. It's 8 p.m. Yeah, he's going to schedule it, guys. It's 8 p.m. the class. Whatever is the time he'll schedule, it's there in your schedule. He'll schedule the class. The office will schedule the class, and you'll all get to know about it. So I'll see you at 8 p.m. We'll study fixed income securities. Okay, thank you. Good night.